Thank you, David. Thank you for having me.
No
Jeremy,
music,
thank you.
no music.
No music. That's what I was about to say. Where's my music? How are y'all doing this morning? Awake? All right. Anybody come from California? I know yeah. I know the person I'm going to interview next did, so it's 5 in the morning for him. I want to jump in briefly about me, just so that you know who's talking to you. I have stuff in the real world. I run a venture capital firm, and then also a whole academic background. Been a professor at Harvard and Columbia, and a member of the NBER. So I have sort of both sides of the world there playing out. And I was a CFO, and it was for a hot second, thank you, yes. Very briefly, sold that company to Lilly and went back to being a venture capitalist. So on the venture capital side, I run an early stage firm. We launch a whole bunch of companies, B2B technology companies. Obviously, I'm a professor at MIT. My partner's out of the Harvard ecosystem, so we really launch a bunch of stuff out of the Harvard-MIT ecosystem. A lot of cool tech stuff. On the academic side, I do research and do some writing. If you really are having trouble sleeping tonight, any of this will work. I also teach, so I teach entrepreneurial finance, and I teach a fun course called FinTech Ventures, where we bring kids from around Harvard and MIT to launch companies. And we try to launch about 10 companies a year out of the Harvard-MIT ecosystem in FinTech. So that one's a fun one. And I still teach a little private equity venture capital stuff at HBS. All right, so what I'm going to talk to you about today is actually some of my research. And since I do run a venture capital firm, the only research I do any longer is things that matter for my real world job. So what is my research on now? It is on decision making actually in investment committees. So I'm going to talk to you guys today about how we can think about making decisions in investment committees. And we're going to start from a place that this is our task. Our task is we need to get our firm to make external investments in tech. Okay? It's our assignment, or to improve our external investing in tech if we already have something set up. Most people, the moment I say this is your job, you need to make some investments in tech, they immediately think, okay, we're going to get together some committee to make these decisions. And I just want to start here because I want to make a couple points to make sure that we're sort of thinking about things the same way. So the first thing is we'd get together this committee and we'd probably have some sort of vote. We'd decide whether or not we thought it was a good investment or bad investment, and we'd vote on it. I emphasize that because I want to make sure people have this idea in their head that at the end of the day, we're not necessarily going to agree. It's not just that we get together, share our information, and then all 100% on the same page. If that were true, we would not need voting. We'd all just be in agreement, right? So we're still going to disagree at the end of the day, which means we must have some sort of different information or different understanding of the situation, even once we've sat down and had it out and discussed it with each other. And the reason we kind of thought of a committee is really for the same reason, is that we did think that we were going to end up with different information, and probably that was because we had different skills in some way, right? When you thought about putting this committee together, you would probably not think, let's put this, people with identical backgrounds on the committee. We'd probably think, let's get some different expertise here, right? Some people might be good at team, others on product, some people on market, might be somebody with finance background, technology, whatever it is, right? And we go here very naturally, and there's a long research, by the way, on sort of wisdom of the crowd or bringing together information from disparate groups, right? So this is our sort of base unit of how we're going to think about making decisions. We're going to get together this committee, different expertise, and now we're going to vote and decide what to invest in. Okay. And the question is, how should we vote? What rule should we use to decide what investment we're going forward with? Okay? And let's just think of some obvious ones, right? Unanimous, i.e. we're going to do the deal if everybody on the committee agrees to do the deal. Okay? That seems like a pretty standard one. Lots of people like it. And you could change it slightly and say maybe unanimous -1. Maybe there's that person on the committee who never says yes. So fine, we do the deal with all but one. The annoying person can't quite stop us. Okay, so we're going to call that unanimous even with the one in or out. Alternatively, the sort of standard way is a lot of people would say, well, let's do majority. We don't need to get unanimity, but just if more of us want to do it than don't, we're going to go ahead and do the deal. And again, we might think majority or we might think supermajority, right? Like just one extra person needs to get in there or whatever it is to get supermajority. Again, very standard. And then alternatively, I just want to throw out kind of a weird rule. We could have a champion rule, right? One person wants to do the deal, we're in. Okay, I mean, I'm pointing it out as it's a possibility, and you could make it, 2 if you wanted instead of 1. Okay. Now, if we thought about it ourselves for a second, right? Let's go back and think about ourselves. If I asked you this crowd, like, how many people would say, yes, the champion's rule is what we're going with? Right, that's pretty much true everywhere I talk about this, right? Like that is just sort of, it feels wrong, it sounds wrong, it seems crazy, right? And so basically everybody would go with majority or unanimous easily. How many unanimous in here? Unanimous, if you thought about yourselves? Majority rules. Most people feel like majority, okay? Feel like one's too extreme, the other's too extreme, we're kind of going to hit the middle. So we went out and we asked. We decided, well, let's see how people make decisions. So we went to the largest venture capital firms in the world. And these are all the firms you know, okay? So just think of any of the great firms in your head. Those are the ones we contacted. And a lot of them won't call me back. But out of 55, we could cajole 35 of them to go ahead and fill out our little survey and tell us how they're thinking about this. Okay, so this is a survey out of them. Okay, here is their formal voting rule when deciding to do a seed deal. The dark blue there is single person can do a deal. The light blue above it is a single person can do a deal as long as nobody stands up and throws up on it, okay? So for 90%, right, of the firms surveyed, a single person can do the deal. Okay, you say, well, that's seed, Matt. How about what if we move to Series A and B? Still, for 50% of the deals, a single person can do the deal. So then we said, well, let's check informally too, right? Because that's the formal voting process. What's the informal voting process, right? We are a small group of people. We wander around the halls and chit-chat. Informal process, it's really exactly the same. 90% of the people basically say somebody can do the deal if they want to do it. And then for a small percentage at the top, you sort of need to gather up a little more of a majority. Okay. Why? This is exactly backward from our intuition, right? We all just voted, and literally none of us wanted to do this. It sounded literally nuts, okay? It does sound kind of nuts. Why on earth would you have a committee and then say one person can do the deal? So that's what we started to get into here. Okay, so let's think about our committee, and let's think about how we vote conditional on being on this committee. Now, this is what most people think about. We have a committee, we're going to vote yes or no, right? And why are we going to vote yes or no? We're going to vote yes or no because we have good information or bad information, right? If I got good information, I'm voting yes. If I have bad information, I'm voting no. Like, in some sense, how else would I vote, Matt? That seems very reasonable. And we think of that as having like some sort of threshold. Like, what do we mean by good information? Well, I don't know. If the information is good enough, I'm voting yes. If the information is not good enough, I'm voting no. Okay, but now I want you to think about this with a particular rule. So I want you to think about your own voting. How would you vote? You're on the committee. And the situation I'm going to look at is the only place in which your vote matters. So here, what I've done is I set up unanimity as the rule. Everybody else has voted yes. Your vote is up. The reason I put everybody else as yes is because if somebody else has already voted no, your vote's irrelevant anyway. It doesn't matter how you vote, right? So this is the only moment where your vote actually matters. Everybody else has voted yes. You've got to decide. Okay. Now, your signal, it turns out, is slightly negative. Just a little bit on the not great side. I want you to ask yourself, are you voting no? It's pretty hard to think about sitting on that committee and being like, no, I know you guys all said yes, but I'm out. It's both socially hard, right? But there might be somebody out there sitting there saying, no, I would stick to my principles and I would vote no. You'd actually be wrong. Okay, so mathematically, it's incorrect to vote no in this case. So it's not just that our intuition suggests that we wouldn't really say no. It's actually mathematically true that you shouldn't say no. Because when you think about this case, you've actually learned something above and beyond your signal, right? you don't just have your own signal now, you now have conditional information. I have the information that everybody else in the committee got a good signal. So actually, we update, and we would update our information and say, okay, my new information is everything I did know and the fact that everybody's saying yes, so actually I'm saying yes. Okay? So that's actually mathematically correct, it's intuitively correct. So what you would really do is you would do this. You would move your signal down. Your threshold to say yes signal down. What did it take to say yes, right? And it's very intuitive. You can feel it. I would definitely not say no unless I kind of had really bad information. I mean, at some point, if everybody else was saying yes and you really had bad information, you'd be like, I got to say no here. I have terrible information. But it would have to be sort of much worse than kind of just a bad signal. OK. Now let's do the same thing, but do it with majority rule. So now, again, we're just going to go to that moment where your vote matters, because any other moment is irrelevant. So the only moment when your vote matters is half of the committee has said yes, half of the committee has said no. Boom, it's your turn to vote. And again, we're going to give your signal slightly negative. Not terrible, but just slightly negative. Now, how do you feel about voting no? Yeah. Yeah. Like, look, half of you said no. I'm just letting you know my signal was negative also, so we're kind of out here, right? Yeah, OK, we're kind of out. Feels perfectly fine. Your signal can be slightly low, and you say, I'm done. I'm out, right? So with this one, we actually, sort of the threshold, it actually doesn't move around. It's kind of the same as your sort of natural previous threshold of like, hey, if I have good information, I'm in. Bad, I'm out. You keep it the same. OK, let's go all the way to our crazy rule. Okay? Here's the champion's rule. Everybody else in the committee has said, no, we're not doing this. And it's time for you to vote, right? Now, when on earth would you say yes? We're now going to give you a signal slightly positive, right, rather than slightly negative, because if it was slightly negative, it's easy, you're out. But we're going to give it slightly positive. You have a slightly positive vote. You're voting yes? I am going to override all of my colleagues. I have a slightly positive signal, we should do it. Obviously, it's the same as the unanimity on the other side. The answer is, no, I'm not being the one person who forces us to do this deal just because I have slightly positive information. So once again, your threshold moves, right? Like, you would say yes, but it would have to be after you had really positive information, right? If you're going to override the committee, you have to be, ready to sort of pound your fist and explain why you love it. I mean, you're going to be like, and everybody's going to be shaking their head at you and wondering about your future career. But, OK, it better be a dang positive signal. OK, and again, mathematically correct also, right? So this is not just sort of your intuitively or your social response to the situation. Mathematically, you have learned something in the moment that you're about to vote yes here. You've learned that everybody else says no, right? And so therefore, you should actually raise your threshold mathematically as well as socially. OK. So now we want to think about the fact that we set this committee with a set of rules, and it changed our decision making. We didn't just go with the same pieces of information making the same decisions. It actually changed how we voted. So therefore, it's going to change what deals get done. OK, so let's think about it for a second. So with unanimity, what kind of deals are going to get done? Well, what you can be certain of with the unanimity voting rule is that no aspect of the deal is particularly terrible, right? Think about our different experts, each with their sort of different viewpoint. Nobody got anything that was like, wow, this is really terrible, right? If we're doing the deal, it must be the case that no one got that really terrible signal, because anything below that line, they would have said no, and that would have killed the deal, right? But we definitely could have a case where some sort of weak deals get done. So that area there under the blue, it's like, well, we all had sort of a positive-ish sort of signal, and sort of everybody else sort of said yes, so we sort of said yes, and we sort of did the deal, even though it was actually not such a great deal. OK, with majority rules, what kind of deals are going to get done? Well, they're definitely going to have a combo of good and bad aspects, right? Like, don't get me wrong, with majority rules, sometimes we might be unanimous or whatever, but in general, what can get done? 3 bad signals, 4 great signals, we do the deal. Right? Some combination of good and bad signals are going to get done. On average here, the good is going to outweigh the bad, right? Because on average, we had to have more yeses than nos. And so, conditional on the math, if you run through all the math of the statistics here, you will, on average, do good deals. But you will definitely do some bad deals, some with bad, right, where the very bad outweighs the good. So we'll end up with some bad deals here. And some good deals. And sort of, it feels very natural. That's why we kind of tend to go here. We know we're going to get bad deals and good deals if we do this. What are we going to get if the champions rule is what we use? Well, we're going to know that at least one aspect is really good, right? Because somebody had to say yes, and they are saying yes when they know that their action, by literally saying yes, you're going to get the deal done. Okay, well, something about what you saw says, hey, this is awesome. So we're going to get deals with at least one aspect very, very good. The other aspects could be abysmal, but at least one aspect is very good, right? Okay, so when we were out asking people and talking about it, here's the quote from Mark Andreessen, founder of Andreessen Horowitz, a very well-known venture capital firm. I'm sure you guys probably all know it. Google, Facebook, eBay, and Oracle all had massive flaws as early-stage ventures, but they also had overpowering strengths. And he goes on to say, some VCs of all their partners score a deal's potential. With that approach, you get the mush in the middle. No great strengths, but no big flaws. So specifically, what they're trying to avoid by using this really bizarre rule of letting one person make a decision is what you get when you get a committee, is you get the mush in the middle. Right? He's trying to avoid that. Remember that area that we got when we sort of had more of a like we all have to like it kind of thinking? We get the mush in the middle. And he's specifically trying to avoid the mush in the middle. Okay, so when should we use each rule, right? So we now have like some intuition about when we might want to use the rule. And the answer is, you have to ask a different question. What will the most valuable firms be like? Right? Because if you think about it, each rule is actually going to get us a different type of investment, a different set of characteristics. So you have to ask yourself, of the investments that I'm doing, what is it going to look like? What are the characteristics going to look like? All right. Here is what we sort of naturally think about, which is why we naturally go with majority rules. We kind of think about, here's the investment value, right? It's got all these different aspects to it, the team and everything along. If each aspect was drawn from a normal distribution, some sort of single modal distribution, not too fat tails, then what would the best deals look like, right? So just picture a world where we're sort of drawing from these different statistics. What would the best deals at the end of the day look like? The best deal would not just be something where everything was perfect, because you actually won't see that, right? Statistically, that you won't see that. I mean, we'd all love the perfect deal with every aspect perfect, but we're just going to see that so rarely we're not going to see it. So if we looked at the distribution of deals at the end of the day, what would the good deals look like when we looked at that right tail of deals? They would be deals that had good and bad aspects, a few more good than bad, which sounds like something one of our voting rules was going to produce for us, right? So actually, if that's your world, then you want to have a voting rule that corresponds with your world. Okay, but what if your distribution looks like this? So this feels kind of weird as an investment. Think of this as an investment where there's not much upside, but lots of downside. We can actually think of that pretty easily when we think about it that way, like almost like a debt-like investment, something where you're sort of saying, look, I'm going to get my yield back, I'm going to get my 7%, and so it doesn't, sort of good characteristics are irrelevant. All I really care about are bad characteristics, right? Because then suddenly I could lose everything. I could not get the money back. But most of these investments, no matter what, are going to kind of earn the same return. There's no real great right side tail. If that's true, then you again looked out of the draw from that distribution, what did the best deals look like when we were done, with all the deals? What would the best ones look like? They would be deals that had no bad attributes. Right? And it kind of feels very natural for a second, right? Because something with a bad attribute is the one that can go bad and lose you all your money. So you're just looking for something with no really bad attributes. You don't actually care very much about something having extra good attributes, so that's going to get you 8% instead of 7%. I mean, nice, but not sort of worth it. You just want to make sure you don't have the left tail. Sounds like one of our voting rules. And alternatively, if the distribution is the other way, what are the best deals going to look like? And this is what's interesting. This is something called the catastrophe principle, actually from insurance. If your distribution looks like this, if this is what we're drawing from, it's actually going to turn out that your best deals are not deals with lots of mediocre, kind of pretty good, okay signals. Your best deals from that distribution of all deals are going to end up something with a fabulous aspect, and all the others are kind of fine, kind of middle of the distribution, but you realize middle of the distribution is kind of not so great. But that's what the greatest deals will look like. Sounds like one of our voting rules. Okay, so superstar projects are then going to be driven in this world by one single superstar aspect, right? And when we go back to this quote and highlight the other part of it, what Mark is pointing out is that Google, Facebook, eBay, Oracle all had massive flaws as early stage ventures, but had overpowering strengths. They're focusing on that one aspect. And you see this if you talk to venture capitalists a lot. They focus on that one thing. Like, had you done diligence, there's famous lines from investors. Had you done any diligence on Twitter, you never would have invested. Okay? That was sort of a famous line from one of the investors. Had you done any diligence on the code base, you never would have invested. So there's lots and lots of kind of terrible aspects of startup or early stage ventures, but something about them makes them overpoweringly positive. How on earth, then, are we going to say yes to that thing that shows up that has something overpowering, but is otherwise bad? Okay, so we then went back, actually, to all the VCs. So we got this. We got this notion. We got this strange result that they used the single person could do a deal kind of rule. And we went back and said, why? Just to make sure it wasn't for some completely different reason than we were now thinking. So we went back and we asked them. We said, is this about, we collected all these different ideas of why it could be. Is it about early stage deals require more specialized expertise? Or our explanation, we're catching outliers. The best early stage deals are extremely promising in some dimensions, but flawed on others. Or is this about effort? VCs care less about small deals, so they don't want to bother getting the whole committee up to speed or whatever it is. So we went back and asked them. And unsurprisingly, the dominant explanation, there's a bunch of dominance characteristics, is that they're just trying to do this to catch outliers. They're trying to grab that weird thing that has one really good aspect and the other things are bad. Now, remember that we did see something, though, that's interesting here. We saw that when they went from seed, right? When they went from seed, it was 90% of the time one person could do the deal. But when they went to Series A and B, it actually dropped. It was closer to 50% of the time that one person could do the deal. So we also asked again, how about if we go to late stage? Okay? How about if we go to your growth investments? And I want to be clear here, this is not a cross-firm effect. We specifically went to the firms that have funds that are seed, Series A, and growth, so that we're not looking at like how do different firms make decisions. We're literally asking the same firm, how do you make decisions at different stages of a company's life if you're trying to do some investment? And they made investments at all these stages. And the answer is within their firm, they both had formal and informal voting processes that looked like this. As it got more growthy, there was far more likely to be majority rules, that's the light blue, and then unanimity. The white there at the top is actually everybody has to be enthusiastic to do the deal. We kind of got to get everybody on board. Whether the rule was formal or informal doesn't matter. Like some places, everybody had to decide they really liked it before we were going to do a growth deal. Okay, well, how does that fit with our thinking? If you actually look at the distribution of returns across these different areas, like sort of what do the deals look like when you do them, what you'll see is, for example, seed, right? In seed, the 75th percentile of a deal is a 0. Like, that's what I do for a living. It's nerve-wracking. Okay, but the 99th percentile is 124 return, multiple, not percent, multiple, right? 100x, 124x. So it's like most things lose money. Every once in a while, something makes an unbelievable amount. Series A and B, less so, right? You make money with sort of more deals, and the deals on the very right are not as amazing. And by the time we get to the C+, which is the growth area, now we're down to at least the 50 percentile is making some money. Not too much, but they're making some money. So none of this is like super low risk, which makes sense, right? We're still talking about venture and fairly early venture, but we're getting less and less skewed. And of course, that exactly matches up with thinking about this. As we get less and less skewed, right, we have less and less need for that one person, that sort of champion, to see something that we all don't see. And we get more like a normal distribution, which gives us the intuition of doing, hey, let's make sure at least a majority of us kind of like this deal. And you see that shift even inside of firms. You do also see it across firms if you ask, but you see it within a single firm, they shift the way they're investing. So that is the idea that I want to leave you with from this talk, is that we all have this intuition. Lots of people use unanimity. By the way, when I go around and talk to firms, I talk to people making decisions, it feels very conservative to use unanimity, right? It feels like this is smart. We're only going to do the best deals if we use unanimity because we're going to get the deals where everybody's on board. Wow, it must be great. It must be the case that like we're all on board. It's got great aspects in every way that we can possibly think about having a great aspect. And the reality is you get exactly the opposite out of that rule. Certainly if something came along that was amazing on every aspect, we would do it. But we would also tend to do a lot of things that were okay. We could kind of all agree on, and that you'll get that out of the rule. With majority rule, it combines information, so we'll definitely get some that are good and bad. And it makes sense as long as the distribution of the deals that we're looking at are kind of normally distributed in a sense. They don't have to be exactly that distribution, but kind of we get that there's kind of a good side, a bad side. Okay, then our voting rule can kind of match that. But if you're looking at something that's like truly, technology crazy, really going to get the change the world kind of tech, something with an extreme tail and lots of chance to fail, then actually, weirdly, you need to move all the way over to this champions rule and let one person pound the table and say, good, you like it? Okay, we're doing it. And I just want to have one last thought here is, this is true even if you have a sole decision maker type viewpoint. Because I could be the sole decision maker. Still, very few sole decision makers sit around by themselves and make decisions. They ask other people, right? So even if I was the sole decision maker, I would still ask you all, well, what do you guys think of the deal? And the question that I should be asking myself is, if you really like it and all of you don't, should I do the deal? Or should I wait until I really see my whole group kind of liking it? And the answer is, even again there, you're deciding, but you're still sort of taking votes from people. If it's more extreme kind of outcomes, you need to be more willing to say, all right, one of you likes it a lot, let's go ahead and do it. Thank you.